Japan Katayama signals a tougher FX stance as yen weakness pushes intervention risk back into focus. The warning matters because a sudden yen support move can ripple beyond currency charts and hit global carry trades. Japanese officials are watching disorderly moves, key USD JPY levels, and speculative positioning as the yen trades under pressure against the dollar. For crypto and other risk assets, the danger is not the yen alone. It is the forced unwinding that can follow a sharp yen rebound. The immediate pressure is that a sharp official move could hit carry trades. The reason this deserves attention is that yen-funded trades can affect global risk appetite. Read the event through this lens. Japan's FX warning puts yen intervention risk back in focus. The confirmed baseline is that Japan's currency authorities are signaling readiness to act against excessive yen weakness. The level map points to areas around 150 to 155 as zones that often trigger verbal warnings or intervention concern. Japan intervened in 2022 after yen weakness passed key levels, with total spending described at 9.1 trillion yen across intervention rounds. The current setup is tied to the gap between Japan's policy stance and higher US rates, which encourages yen selling. Those facts put levels near 150 to 155 are closely watched. Beside 2022, intervention spending reached 9.1 trillion yen. That baseline keeps the segment grounded before the mechanism takes over. The factual floor is the warning centers on disorderly moves and key USD JPY levels. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The mechanism is direct currency intervention. Japan's Ministry of Finance can instruct the Bank of Japan to buy yen and sell dollars, increasing demand for the yen in the market. In plain English, officials can try to shock traders out of one-way bets by creating sudden yen strength. Japan Katayama Signals matters here because intervention can move prices fast even if it does not solve the underlying rate gap. The operating detail is that buying yen can shock one-way currency bets, while the rate gap still drives underlying pressure. That is the part viewers need before judging the headline. The mechanism stays concrete because officials can buy yen and sell dollars directly. The affected side includes importers, exporters, currency traders, and investors using yen-funded carry trades. A stronger yen can ease import costs for Japan, but it can reduce the value of exporters' overseas earnings when converted back to yen. Globally, a sudden yen spike can force investors to unwind trades funded in yen, adding volatility to stocks and crypto. That risk is real, but intervention is not confirmed until authorities act. The practical effect lands on carry trade investors because import costs can ease with a stronger yen. The secondary read is that exporters may lose currency translation benefit. The effect is not abstract. Carry trade investors could face forced unwinds if yen spikes. The unresolved piece is whether the warning is jobbing or preparation for actual market action. Words can slow speculation for a while, but lasting relief usually requires either intervention scale or a shift in underlying policy pressure. A rapid USD JPY move, official buying, or clearer coordination would show that the warning has become action. The statement should not be treated as proof that intervention has already happened. The clean split is that the warning is confirmed. While actual intervention still needs evidence, the unsupported leap would be this: verbal pressure is not market action. The clarification needed is official. Yen buying would clarify the next stage. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The next signal is disorderly USD JPY movement near the watch levels. For Japan Katayama Signals, a fast one-day yen drop or another push through key levels would raise the intervention risk. If officials step in, the immediate market read is not just yen strength, but carry trade stress. That is why currency warnings can matter for crypto, even when the headline is outside digital assets. The decisive test is watch the 150 to 155 zone. That matters because disorderly moves raise intervention odds. The next stage should be judged by fast USD JPY moves, not by guesses.